Good.
you all for attending our annual payroll and year-end reporting webinar presented by Hawkins Ash CPAs. Hawkins Ash CPAs ranks among the top 200 firms in the nation. With 10 offices in Wisconsin and Minnesota, our 175 employees provide local tax, audit, and accounting solutions to our clients. Learn more about Hawkins Ash CPAs on our website, hawkinsash.cpa. So with that, I have the pleasure of introducing Mark Porter. Tax Supervisor Mark Porter is fluent in utilizing and training clients in the use of QuickBooks, Sage, and Petrie. He has more than 23 years of experience in public accounting and has worked in all aspects of the accounting process, including accounts receivable, accounts payable, tax return preparation, bookkeeping reconciliation, and financial statement preparation and review. So we have a lot of content to cover. Mark, why don't you take it away?
Okay, thank you, Corrine. So good morning, everybody. Like Corrine said, my name is Mark Porter. Today we'll be speaking on some payroll benefits and a few miscellaneous year-end reminders for 2023, as well as any changes that were been made available for 2024. So some of the topics that we're going to be discussing, like I mentioned before, some 2023, 2024 changes, some W-2 information, pre-tax benefits, some details on some of the more major well-known fringe benefits, the difference between employee and independent contractor as far as 1099 issuing goes, some information about the Affordable Care Act, and then some miscellaneous things as far as Wisconsin and Minnesota go. So let's to continue on. So the Inflation Reduction Act was extended through the year 2025. A couple of reminders. Masking the employee social security number on W-2 is okay, but you cannot do that on anything that you file with the state or Social Security Administration. We'll go through briefly the white collar salary threshold that's in the process of being updated. I'll talk about the Form W-4, W-2 e-filing requirement, some tax rate changes, any maximums that have changed from 2023 to 2024, as well as some links that you can find, employment posters that are required to be posted at your place of business. So the Affordable Care Act, the employer shared responsibility payments, that's for 50 or more FTE employees and full-time equivalents. If an employer's lowest cost health plan premiums are not affordable to the employer may be liable for the employer shared responsibility amount when the employees enroll in the marketplace coverage to get coverage for them and potentially their family as well, and if they qualify for the premium tax credit. As far as masking the employee social security number goes, so starting in 2021, the employers can truncate the employee social security numbers on the employees' forms copies, but are not allowed to do that, like I had mentioned before, for anything that's sent to Social Security Administration or the individual states. The weekly white collar salary threshold, currently the salary level increased to $684 per week on 1/1 of 2020 for a yearly amount of $35,568. The DOL's proposed revision will hopefully see an increase in approximately $1,059 a week or $55,068 per year. So now the 2021 Form W-4, the employee's withholding certificate. The new W-4 required to be used for new hires on anybody that's hired after 1/1 of 21 and any employee that wants to change their withholding numbers. The Social Security, the update to the e-file W-2 requirements. They now mandate electronic filing for the IRS forms, including the W-2s in 2024 for the 23 W-2s. If you send 10 or more W-2s to the Social Security Administration. Both the Wisconsin and the Minnesota e-filing requirements for 10 or more and the W-2s, which includes the W-2s plus the 1099s and for informational forms. So this is a key fact sheet for 2023. This just kind of goes over the changes from 2023 to what's currently available on 2024. So of course, the employee and employer Social Security rate remains at 6.2%. The Social Security wage limit that went from $160,200 to $168,600 for 2024. The Medicare rate as well is unchanged at 1.45%. And for all wages over $200,000, the additional Medicare rate is 0.9%. And again, as all years prior, the Medicare wage limit, there is no wage limit. So that goes all the way up to as much as you can make. So the federal unemployment rate, that remains unchanged as well at 0.6%, as well as the federal unemployment limit at $7,000. So the Minnesota wage limit for 2023, the taxable wage base was $40,000. That has not been released yet for 2024. The Wisconsin unemployment wage limit stays the same at $14,000, as well as the federal minimum wage, that's at $7.25. The Minnesota small employer minimum wage went from $8.63 to $8.85, and the Minnesota large employer went from $10.59 up to $10.85. For Minneapolis and St. Paul, it's all based on the number of employees, and the Wisconsin minimum wage rate follows Fed at $7.25 per hour. So the next fact sheet, this kind of goes through everything as far as the limits go and the changes for retirement plans, tax favor plans, as well as the IRS standard mileage rates. So the change for 401k, 403b, 457b went from $22,500 for 23 up to $23,000 for 24. The catch-up remains the same at $7,500. The simple plan contribution for employers, that's $15,500 for 23, and for 24 it goes up to $16,000. The catch-up contribution remains the same at $3,500. IRA contributions for both Roth and traditional IRAs went from $6,500 in 23 to $7,000 in 2024. And that catch-up contribution, that has also remained the same at $1,000. The HSA for single taxpayers went from $38.50 in 2023 up to $41.50 in 2024. For family coverage, went from $77.50 in 2023 up to $8,300 in 2024. The catch-up for those has remained the same as well at $1,000. The Health Flex Spending Account, that went from $3,050 in 23, now it's up to $3,200 for 24. The dependent care amount that you can have withheld from your paychecks on a pre-tax basis, that stayed the same as well at $5,000. As far as the mileage rates go, general mileage rate for 2023 is 65.5 cents per mile. For medical and moving expenses is 22 cents per mile. And charitable is 14 cents per mile. None of those, unfortunately, are available yet as of the completion of the slides for 2024. So as far as Minnesota and Wisconsin goes, other states may vary. So this information is strictly for Minnesota and Wisconsin. The cafeteria plan, code section 125. So that is exempt from all taxes, both federal, state, Social Security, Medicare, and both federal and state unemployment. The 401k, it's pre-tax for both federal and state income taxes, but it is taxable for everything else, for Social Security, Medicare, federal and state unemployment. The health insurance paid for by the S Corporation for greater than 2% shareholders, that is taxable for federal and state only. Personal use of a company vehicle, that's taxable for all. HSA accounts, that's pre-tax, federal, state, Social Security, Medicare, as well as federal and state unemployment. So for the required employment posters, so we've included both the federal, Minnesota, and Wisconsin sites that you can find those posters on that have to be posted at your place of business for all employees to be able to view. Now we can move on to some W-2 information. So January 31st, 2024 is the due date for filing all 2023 forms W-2, W-3 with Social Security Administration. You can file those either paper forms or electronically if you're under the 10 limit. You can request a 30-day extension to file with the Social Security Administration. In order to do that, you have to fill out and file Form 8809 by January 31st of 2024. You must still provide the W-2 copy to the employee by the 31st of 2024 in January. You can request an extension of time to furnish W-2s to employees. You have to fax a letter to the IRS, including your name, address, federal ID number, the statement that you're requesting an extension to furnish the forms, W-2 to your employees, the reason, and the signature by you or an authorized employee. I have tried this personally twice in the past, did not have good results, so I would recommend you do everything by the 31st. And then moving on, so the next slide, this is just an updated copy for the 2023 W-2. Again, it's due on the 31st of January, and you can file for an extension by filing Form 8809. So this is like a brief calculation showing how to come to your federal taxable wages. So you start out with your gross wages, minus the pension plan amounts, minus any 125 amounts. The 125 amounts you can have, depending on what your plan document states, you can put pretty much anything inside of a cafeteria plan. So it's not just subject to only health insurance premiums. So if you look at the example, you start out with $250,000 in gross wages, you subtract 125 health insurance premiums, the $5,000 of pre-tax dependent care benefit. That brings you down to the net taxable wages for Medicare purposes of $240,200. Subtract from that your 401k deferral, and you end up with $232,700 of federal taxable wages. So this is another quick example of taxable wages for Social Security purposes. So again, the rate's still at 6.2% on the first $160,000, $200,000 of wages for 2023. Section 125 plan items are not subject to Social Security tax, income tax, or either federal or state unemployment. It's reported in box 3 of Form W-2, it tips box 7. So the example, it starts out with $250,000 of wages. Again, you subtract the $4,800 of 125 plan premiums, $5,000 for the dependent care benefit. Leaves you down to net taxable wages for Medicare of $240,200, but you're still capped at $160,200 for Social Security purposes. All right, so taxable wages for Medicare, so there's 1.45%, there's no limit. The additional Medicare tax of 0.9% is anything on wages over $200,000. So the example, again, we start with $250,000 of gross wages, subtract the $4,800 of 125 health insurance premiums, $5,000 of dependent care benefit. Again, that brings you down to $240,200 of net taxable wages for Medicare. Everything over $200,000 is taxed at the 1.45% plus the 0.9% at 2.35%. So that would be $40,200 at the 2.35%. Okay, so this next slide, so this is, I won't bore you with all the details of this, but this is the different codes that you can put down in box 12. For different items, it goes through, group term life insurance, retirement plans, deferrals, 457 plans, sick pay, some additional benefits, combat pay, things like that. You can read this in more detail at your leisure. One note, code DD is only required if you have 250 or more forms W-2. All right, so moving on to supplemental wages. So supplemental wages are payments to an employee that aren't considered regular wages. They're included, but not limited to bonuses, commissions, payments for accumulated sick leave, severance pay, awards, prizes, back pay, any retroactive pay increases, taxable fringe benefits, expense allowances paid under a non-accountable plan, and payments for non-deductible moving expenses. So for as far as federal withholding on supplemental wages goes, so if you pay supplemental wages with regular wages but don't specify the amount of each, you have to withhold federal income tax like a normal pay period. So if you have supplemental wages that are identified separately from regular wages, if you pay supplemental wages separately, or you combine them in a single payment and specify the amount of each, if income tax was withheld from an employee's wages in the current or immediate preceding calendar year, you would withhold at a flat 22% and withhold as like a normal pay period. An employee receives more than $1 million of supplemental wages during the calendar year, you have to withhold at 37%. Without regard to the employee's W-4 that you have on file on the amount that is over $1 million. Minnesota withholding on supplemental wages. They follow federal guidelines, so same thing for federal as far as Minnesota goes. If you pay supplemental wages separately from regular wages, you withhold at 6.25% on the supplemental wages, regarding of any W-4 withholding allowances that the employee filed. Now over to Wisconsin for withholding on supplemental wages. So if it's paid with regular wages, you withhold as if the supplemental wages were one. If paid between regular payroll periods, determine the tax by adding the supplemental wages to the current payroll period or the last preceding payroll period within the same calendar year. So there's flat percentage rates in Wisconsin. From 0 to 12,760, you're paying a flat rate of 3.54%. And from that upper limit to 25,520, 4.65%. And then from 25,520 to 280,950, it's 5.3%. Anything above that is 7.65%. So 401k, 403b, simple IRAs on the W-2, pre-tax for federal and state only. It's not deducted from Social Security tips, or Medicare. 401k Roth contributions are after-tax contributions. 401k and Roth 401k combined totally may not go over the yearly maximum allowed for individual married taxpayers. Okay, so this is kind of like a little check the box or not to check the box as far as the retirement plan goes. Again, you can read this in more detail on your own, but kind of goes through the type of plan, goes through all the different types of plans, including a profit sharing plan, the specific conditions, and whether or not you should check the retirement plan box or not. So box 12 for the codes for retirement plan. So this goes through everything, including the after-tax Roth contributions. So it goes from 401k, 403b, 457b, Roth contributions, under 401k plan, under 403b plan. So next, so this is a reconciliation spreadsheet to give you an idea of how to reconcile payroll. So it includes all 4 quarters and the year end. I won't bore everybody with all these numbers and the details, but it kind of just goes through and it tells you what the Social Security tax is, the Medicare tax. If there's additional Medicare tax, includes 401k information in there, includes the UC 101, which is state unemployment. And then on the far right side, it goes through what box to put the amounts in on the W-3. And so I believe this is one of the spreadsheets that was sent out along with the PowerPoint presentation slides. So you can use this and it will automatically fill everything in. So for sick and family leave wages, on the Form 941, the qualified sick leave wages and qualified family leave wages paid during a quarter of 2023 for leave taken after March 31st of 2020 and before April 1st, 2021 are reported on 941 lines 5AI and 5AI2. Qualified sick leave pay and qualified family leave pay paid during the quarter of 2023 for leave taken after March 31st, 2021 and before October 1st, 2021 are reported on those same lines on the 941. So now we can get into talking about some pre-tax benefits. So some tax favorite health plans. The first one is health savings account. So some of the benefits of that, the contributions are pre-tax. You're permitted to take a distribution at any time. Only qualified medical expense can be reported as non-taxable. Anything that is not a qualified medical expense will be taxable. Any interest or earnings on the health savings account are tax-free. It's portable. You can carry forward it from year to year. Some of the qualifications: you must be covered under a high deductible health plan. For 2023, for single taxpayers, that's $3,850. $7,750 for family. In 2024, it's $4,150 for single taxpayers and $8,300 for family. Additional contribution if you're 55 or older of $1,000 you can put in. You cannot have any other health coverage except what is permitted, and you cannot be enrolled in Medicare. You cannot be claimed as a dependent on someone else's tax return either. So partners and 2% or greater shareholders of an S corporation are not eligible for the salary reduction contribution to an HSA. Those shareholders greater than 2% of an S corp, that should be noted in box 14 of the W-2 along with the amount of the health insurance paid. And then your individual tax preparers, though they can take that as a deduction on your personal tax return if qualified. So MSA accounts, medical savings accounts, some of the benefits of them. You can claim a tax deduction on your 1040 for your contributions on Form 8853. Again, only qualified medical expenses are deductible. And same as the HSA, interests and earnings are tax-free, portable, and you can carry forward the benefits. Some of the qualifications: employees of a small employer, which is 50 or fewer employees during either of the last 2 calendar years. Self-employed persons, self-only or family high deductible health plan, cannot have health or Medicare coverage. The annual limit of 75% of the annual deductible of a high deductible health plan. That's 65% for a self-only plan. The employee, employer, self-employed can make contributions. Employer, employee cannot make contribution in the same calendar year. So an HRA, this is a health reimbursement arrangement. This is funded solely by the employer. Employees are reimbursed with tax-free money for qualified medical expenses. There's no limit on the amount of money your employer can contribute, and you can carry it over to the following year as well. A qualified small employer HRA, again, that's with 50 full-time or equivalent employees or less. The 2023 limit is $5,850 for individual, $11,800 for family. 2024 limit is $6,150 for individuals, $12,450 for family. Flexible spending arrangement, FSA. It's a medical care reimbursement. It's a health FSA, dependent care assistance, and adoption assistance. So the health FSA, that is funded through voluntary salary reduction, which is pre-tax. The employer can also contribute if it's specified in the plan document. Maximum contribution is $3,050 per year. Some of the benefits: the employee is reimbursed for medical expenses. The employer contributions are excluded from gross income. Some of the qualifications that you need, it has to be employer established, and self-employed people are not eligible. The employer may match up to $500 to the FSA, starting at $501. Employers can only make dollar for dollar match. The employer may utilize a carryover or grace period option under special rule for health or dependent care FSAs. The carryover option, the employee may be able to carry over $610 in 2023 of unused funds to the following plan year. The grace period option, the employee has 2.5 months after the end of the plan year to incur eligible expenses. Special COVID-19 relief that gave employers the option to allow employees to carry over their unspent 2021 balance to 22 has not been extended into this year. Okay, so the dependent care FSA, it's pre-tax used to pay for daycare, preschool, and summer camps, and non-employer sponsored before and after school programs. You cannot use it for overnight camps, the expenses relating to children under 13 years of age or special needs children. You cannot discriminate. Limit for 2023 is $5,000. Adoption assistance, that's pre-tax as well. It's used to pay for necessary and reasonable expenses relating to adopting a child. It phases out based on your income. It cannot be used to adopt your spouse's child. The 2023 maximum amount is $15,950. 2024 maximum amount is $16,810. All right, health insurance premiums for 2% or greater shareholders of S corporations. The health insurance premiums paid to those shareholders are considered wages. They're subject to federal income tax withholding, but they're exempt from Social Security, Medicare, and federal unemployment. Health insurance provided solely to 2% or more shareholder employees of an S corporation, not to other employees, does not qualify for the FICA exemption and is taxable for Social Security purposes, Medicare, as well as federal unemployment. And you can take it as a distribution. HSAs for those same partners and S corporations, partners in 2% or greater shareholders of an S corp are not eligible for pre-tax contributions to an HSA. Employer contributions are treated as distributions or as a guaranteed payment. And keep in mind that guaranteed payments are taxable and they are subject to self-employment tax as well. Third-party sick pay, fully taxable if the employer paid or the employer paid for the policy with pre-tax dollars. It's non-taxable if it was paid with after-tax dollars. That's pretty much self-explanatory there. It's partially taxable if the cost was split and you need to prorate it between the after-tax dollars and the pre-tax dollars. If the insurer is not preparing a W-2, benefits must be added to wages. Record a manual check, reported in boxes of the W-2 of 1, 3, 5, and 16. And you check box 13 for third-party sick pay. Insurers may need to complete Form 8922. It's a third-party pay recap sheet. Okay, so this third-party sick pay, this is another chart. You can read it in more detail as time permits on your own. Briefly, it just goes through the withholding employee taxes, what you're doing with the trust fund taxes for the employer, and it goes through and it says if it's an employer responsibility or a third-party responsibility. And like I said, you can go through that in more detail at your own pace. All right, so we'll move on to some details on some fringe benefits. So this is a copy of the chart for the IRS publication 15B. If you want to download the whole publication, it's not very long. It's only 34 pages. You can do that on the IRS website. It's very easy to read and understand. It's not very long. It's a good resource if you want to print that out and keep that on file. So the IRS regulation, code section 1.61-1, gross income means all income from any source derived unless excluded by law. Gross income includes income realized in any form, whether in money, property, or services. Income may be realized, therefore, in the form of services, meals, accommodations, stock, or other property, as well as cash. There's an optional special accounting rule. The employer may elect to treat the value of taxable non-cash fringe benefits provided in November or December or any other shorter period during that time as paid in the subsequent year. This applies only to the benefits actually provided during November and December, not to the benefits that were provided earlier in the year, but are treated as being paid during those particular months. The special accounting rule is limited to non-cash fringe benefits. Employer provided vehicles. Personal use of a company vehicle is commuting to and from work. Trips not related to work, used on vacation, used by someone other than the employee. Personal use of the company vehicle is subject to federal Social Security, Medicare taxes, also subject to federal unemployment tax. It's reported on W-2 in box 135, 16, and 14 as an other addition. The employee must substantiate mileage between business and personal use, or full use of a vehicle can be included in the employee's income by using one of 4 different valuation methods. We will go through those as well briefly. The different valuation methods are the general valuation method. Costs the employee would incur to lease the same vehicle in the same area and in the same period the automobile is available to the employee for personal use. The special valuation method, commuting valuation, cents per mile valuation, and the annual lease valuation. The general valuation rule, the value that the employee would have to pay a third party in an arm's length transaction to buy or lease the vehicle in the area where the employee uses the vehicle. The commuting rule, the employer can value personal use at $1.50 for each one-way commute. So for round trip, it'll be $3. You can use this method if the following conditions are met. The employer owned the vehicle, is provided to employee for company business and de minimis personal use, such as a stop for a personal errand on the way between a business delivery and the employee's home. The second one, employer must have a written policy prohibiting the employee from personal use other than commuting and de minimis personal use. Number 3, the employee doesn't use the vehicle for personal purposes other than commuting and de minimis personal use. Employee is not a control employee, director, elected officer with wages of $130,000 or greater. An employee with wages of $265,000 or more owns 1% or more equity, capital, or profits interest in the business. You can switch to the lease value rule on the first day, which you don't use the commuting rule. The cents per mile. You cannot use if the vehicle's value when it is made available to the employee is more than $60,800. Fair market for personal use is determined by using standard mileage rate of 65.5 cents per mile for 2023. This includes the costs of maintenance, insurance, and fuel. If you don't provide fuel to your employees, you can reduce that rate by 5.5 cents per mile. The 2024 standard mileage rate has not yet been published. To use this rule, one of the following conditions must be met. You expect the employee to regularly use the vehicle for business throughout the year. At least 50% of the total mileage each year must be for business, or the vehicle is generally used each workday to transport at least 3 employees to and from work in an employer-sponsored commuting pool. The mileage test is met. The vehicle is driven by employees at least 10,000 miles per year, both business and personal combined. The vehicle is primarily used by employees. All right, more information on the cents per mile. There's a consistency requirement. You must begin using the cents per mile rule on the first day you make the vehicle available to any employee for personal use. Items included in the cents per mile are maintenance and insurance. You must also use the cents per mile rule for all later years in which you make the vehicle available to any employee and the vehicle qualifies. Number 3, you must continue to use the cents per mile rule if you provide a replacement vehicle to the employee and the vehicle qualifies for the use of this rule. And your primary reason for the replacement is to reduce federal taxes. Can reference again Pub 15B for issues related to this rule. The annual lease valuation. The fair market value is determined by multiplying the annual lease value of the car by the percentage of personal miles driven. You determine the fair market value of the vehicle as of the first day it was made available to any employee for their personal use. The fair market value of an automobile is the amount a person would pay to buy it from a third party in an arm's length transaction in the area in which the automobile is bought or leased. That amount includes all purchase expenses such as sales tax and title fees as well. You use the annual IRS annual lease value table to calculate the percentage of the personal miles driven. Multiply the annual lease value by the percentage of personal miles. Personal miles divided by the total miles equals the percent of the personal miles driven. If you provide the fuel, you must add 5.5 cents per mile. Annual lease valuation continued on. Consistency requirements. You must begin using this rule on the first day you make the automobile available to any employee for personal use. You must use this rule for all later years in which you make the automobile available. You must also continue to use this rule if you provide a replacement automobile. You can also see Pub 15B for this. Items included in the annual lease value table include the value of maintenance and insurance. It does not include the value of fuel you provide or pay for. You must include the value of the fuel separately in the employee's wages, either at fair market value or 5.5 cents per mile. Any use of a company provided vehicle that isn't substantiated as business use is always included in income. This next slide here, this is directly out of the Pub 15B. This goes to show you what the market value is, the annual lease value for everything up to $60,000. And that table can be used to fill in some cells on this spreadsheet. So this spreadsheet, I believe this was included in the ones that were sent it out in the PowerPoint presentation along with it. So I won't bore you with all the details of this, just basically goes to show different scenarios, different mileage amounts, different annual lease values, different personal use percentages and things like that, and how you calculate the employee amount that's taxable. So like I said, I won't bore you with all the details of that. If anybody has any questions regarding this, you're more than well happy to answer them through email. So on to another fringe benefit. So group term life insurance provided by your employer. It is non-taxable for the first $50,000 of coverage if it provides a general death benefit that is not includable in income. If it provides to a group of employees of more than 10, even if not all employees choose a benefit. You can see Pub 15B for those exceptions. Provides an amount of insurance to each employee based on a formula that prevents individual selection, and provided under a policy that the employer either directly or indirectly carries. Any amounts over $50,000 reduced by any employee after tax payroll deductions is taxable income. And that taxable income is taxable for Social Security and Medicare. It's also taxable for federal withholding, but the employer does not have to withhold. Non-taxable for both federal and state unemployment. W-2 goes in box 12 with code C. You can prorate the cost if less than a full month of coverage. 2% or greater S-Corp shareholders, it's all included in wages. It's non-taxable to the employee when the beneficiary of the policy is a company for the entire calendar year, and the beneficiary of the policy is a charitable organization for the entire calendar year as well. Or when the employee terminates during the year due to a permanent disability. So calculating excess group term life insurance coverage to determine the excess over $50,000 to the nearest $100. You divide the excess by $1,000, determine the employee's age as of the end of the year. You multiply that rate by the rate found in Pub 15B, which on the next slide, by the amount in step 3, and you deduct any after-tax employee contributions. Additional rules, the spouse dependent group term life insurance and former employees group term life insurance. You can review Pub 15B for that as well. So this is the factor that you use for a cost per $1,000 protection per 1 month. It goes from under age 25 to 70 and older. So this spreadsheet, the group term life calculation, I believe this one was also sent out with the PowerPoint presentations. So this shows everything on how to calculate different amounts of group term life insurance that were provided to an employer that's over $50,000. And again, I won't bore you with the details of all the numbers, but it's pretty much self-explanatory. And on the very right, it just gives you the grossed up value, if needed, about what the taxable amount will be. Moving expenses. So effective starting 1/1 of 2018 and years before 12/31/25, moving expenses are no longer a tax-free perk from employers and as an above-the-line deduction as well. Members of the armed forces who are on active duty and who move because of a permanent change of station are excluded as long as the employee did not get reimbursed. There's a link there to the IRS website. You can look at a publication there for more details on the armed forces deducting moving expenses. Education assistance. Certain job-related education that you provide to employees may qualify for exclusion as a working condition benefit. The education must meet at least one of the following tests. The education is required by the employer or by law for the employee to keep his or her present salary and or job or status. The required education must serve a bona fide business purpose of the employer, and the education maintains or improves skills needed in the employee's job. However, if the education tests are met, it isn't qualifying education if it is needed to meet the minimum educational requirements of the employee's present trade or business as part of a program, a study that will qualify the employee for a new trade or business. If you receive educational assistance benefits from your employer under an educational assistance program, you can exclude up to $250 of those benefits each year. Business travel, meals and entertainment, gifts, transportation. So now this is under an accountable plan, so keep that in mind. It's not a non-accountable plan, but an accountable plan. Allowances or reimbursements paid to employees for job-related expenses are excluded from wages and not subject to withholding. An allowance or reimbursement policy, not necessarily have to be a written plan, is considered an accountable plan if there is a business connection to the expenditure, like the expenses were incurred while performing services as an employee. There is adequate accounting by the recipient within a reasonable period of time. Bills, receipts, canceled checks, or similar items to support the expense. Excess reimbursements or advances are returned within a reasonable period of time. The determination of length of a reasonable period of time will depend on the facts and circumstances. Now, on a non-accountable plan is an allowance or reimbursement that does not meet all three of the requirements above. The payment, reimbursement, etc. of these expenses are taxable wages to all withholding, subject to all withholding, pardon me. An expense that is lavish or extravagant is not allowed. Business travel, the IRS announced special per diem rates that can be used to substantiate the amount of business expenses incurred for travel away from home on or after October 1st of 2023 through September 30th of 2024. Employers using these rates to set up per diem allowances can create certain categories of travel expenses as substantiated without requiring that employees prove the actual amount they spent. Employees should still substantiate the time, place, and business purpose of their travel expenses. Prior to October 1st, 2022, per diem allowance for traveling each day is non-taxable. Allowance amount is deemed substantiated as long as it does not exceed IRS established federal per diem rates. If it exceeds these rates, any overage is taxable. Federal per diem rate is a combination of both the federal lodging expense and the meals and incidental expense for the locality of travel in the continental U.S. A little side note, if you're using these expenses for like over-the-road truck drivers that remain in their semi-tractor trailer, you don't use the lodging expenses, you just use the M&IE expenses for that. There's a link for a website here that you can look up the different per diem rates, which would include high and low cost locales, things like that. The mileage reimbursement is non-taxable up to the federal standard mileage rate as long as it's substantiated. Any reimbursement over the federal rate is taxable. An employer is allowed to pay under the federal rate as well. The mileage rate, like we discussed earlier, for 2023 is 65.5 cents per mile. It's not available yet for 2024. For loans that employers give to their employees. If the loan is made at an interest rate below the applicable federal rate, the difference is taxable on any day that the outstanding loans are more than $10,000. The taxable amount is subject to Social Security, Medicare, federal and state unemployment. It's also included in box 1 of the W-2 as taxable wages. The applicable federal rate can be found at this link here, and that changes regularly. So if you're doing loans to employees, I would keep an eye on that. Any loans under $10,000 to an employee. There's no imputed interest unless the principal purpose of the loan is tax avoidance. No imputed interest on loans for relocations to a new principal place of work. No imputed interest on advances repaid within a reasonable period of time. And proper documentation of any loan to an employee is very important. The employer's cancellation of an employee loan results in cancellation of debt income. Rather than compensation, the canceled loan should be reported on Form 1099-C, which is cancellation of debt. Prizes and awards. Awards and prizes, they are generally included as income with a few certain exemptions. Achievement/safety awards that are given to an employee for length of service. The employee achievement or safety achievement award is tangible personal property, not cash or a cash equivalent, stocks, vacations, meals, lodging, or tickets. Award is given in a meaningful presentation. The award is not disguised as compensation. Length of service award is excluded from income if the employee receives the award after their first 5 years of employment, but not more frequently than every 5 years. The employee didn't receive another length of service award during the same year or in any of the prior 4 years. There's a limit of $400 for awards under a non-qualified plan, limit of $1,600 for all awards in a calendar year, whether or not qualified. All right, so back pay and legal awards. Back pay is awarded to a taxpayer, constitutes wages, and is reported and fully taxable on Form W-2 in the year that it was paid. Awards for punitive damages, non-physical injury or sickness, discrimination or defamation is considered income, but are reported in box 3 of Form 1099 Miscellaneous. You can see the instructions for more information on that. Jury duty pay. Any pay by employer above and beyond what an employee gets paid from any court is taxable. If the employer requires the employee to turn over jury pay, only the difference between the amount paid and turned over is taxable. Okay, tips. Tips are taxable income. Does not include allocated tips, which are reported in box 8 of Form W-2. Earnings of $20 a month in tips must be reported by employee to employer by the 10th of the following month, or more often if the employer requires it. It's reported on Form 4070 or a similar statement. Service charges are not tips, but are wages. These charges are added to a customer's check without the customer having a right to determine the tip line. Some examples: large dining parties that have automatic gratuities added to their check, banquet event fee, cruise ship package fee, bottle service charge, hotel room service charges. Gift cards are always taxable. They have a specific value, and it's not unreasonable or administratively impractical to account for gifting of gift cards. You can look at Internal Revenue Code section 132 for more information on that. Employer provided cell phones. If they're provided for non-compensatory business reasons, is not a fringe benefit for business reasons. The employer needs to contact the employee at all times for work-related emergencies. The employer requires the employee to be available to speak with clients at times when the employee is not at the office. The employee needs to speak with clients located in other time zones at times outside of normal business hours. Adding fringe benefits to the employee's pay. If fringe benefits are entered with a regular payroll, taxes are calculated, so it may not be necessary to gross that amount up. Federal and state income tax withholding is not required. If fringe benefits are entered after the final payroll of that year, it will need to be grossed up for Social Security and Medicare purposes. So if you want to gross up an amount for a payroll to end up with a zero check or any particular amount that you want that's below the Social Security limit, you take the Social Security rate of 6.2% and Medicare rate is 1.5% for 7.65%. You subtract the total rate from 100, which gives you 92.35%, and you divide that desired net pay by 92.35%. If you're over the Social Security limit, the Medicare rate is 1.45% or 2.35% if you add in the 0.9 of additional Medicare tax if your wages are over $200,000. Subtract the total rate from 100, equals 98.55%. Then, or if over 200,000 limit, 97.65%, and divide that by 2.35%. Verify fringe benefits are added to box 1, 3, 5, and 16 on Form W-2, and it's listed in box 14. If not, give the employee separate sheet to accompany the W-2 if you have too many things to put into box 14. De minimis fringe benefits. De minimis fringe benefit is any property or service that's provided to an employee that has so little value, taking into account how frequently you provide this benefit to an employee, that accounting for it would be unreasonable or impractical. Cash and cash equivalents, gift cards, charge cards, or credit cards, no matter how little, are never excludable as a de minimis benefit, except for the occasional meal money or transportation fare. Some examples of de minimis benefits: occasional personal use of employee's copy machine has to be 15% or less. Occasional group meals or picnics for employees. Traditional birthday or holiday gifts of property, not cash, with a low market value. Occasional theater or sporting ticket events, coffee, donuts, soft drinks, local telephone calls, some other miscellaneous things like flowers, fruit, books, similar property provided to employees under special circumstances, such as illness, outstanding performance, family crisis. All right, now we can move on to some information about independent contractors and the difference between an independent contractor and employee. So in recent years, this has become a pretty hot topic from the IRS. I have gone through personally a few audits related to this. They're not very forgiving if you treat somebody as an independent contractor who should actually be an employee, most likely because they don't get their Social Security on it. So to be an employee, your employer controls when you work, how you do your work, and the employer supplies, tools, know-how, all that kind of thing. They also provide benefits like vacation, PTO, health insurance, retirement plan benefits. To be an independent contractor, the individual has written contract that states how long the project will potentially take, what happens if the project is not completed satisfactory. They get no reimbursements for expenses, gas, supplies, tools, anything like that. And they pay in their own Social Security and Medicare. So it's federal test for independent contractor. Common law rules, facts that provide evidence of the degree of control and independence fall into three separate categories. First category is behavioral. Does a company control or have the right to control what the worker does and how the worker does his or her job? The second test is financial. Are the business aspects of the worker's job controlled by the payer? This includes things like how the worker is paid, whether expenses are reimbursed or not, who provides tools and supplies. The third rule is the type of relationship. Are there written contracts or employee type benefits, pension plan insurance, vacation day, pay, PTO, things like that? Will the relationship continue, and is the work performed a key aspect of the business? Wisconsin, Minnesota, there is a 9-requirement test for an independent contractor. You have to maintain a separate business, maintain a federal ID number, or have filed a business or self-employed income tax returns with the IRS based on the work that you're doing or the service that you're doing in the previous year. Social Security number is not substitutable for a federal ID number, and it does not meet the legal burden of Section 102.078 of the Wisconsin statute. You have to operate under specific contracts. You have to be responsible for all your main expenses, and you have to satisfactorily complete the work or service, receive compensation under a contract per job by commission or by competitive bid. You have to realize a profit on the job or suffer a loss, recurring business liabilities or obligations, and the relationship of business receipts to expenditures. So there's a couple online links here that you can go to get a little bit more detail on these. So to be an independent contractor, you have to have a contractor complete a Form W-9 and request a copy of their COI, their certificate of insurance, that needs to include both workers' comp and general liability. If you pay an independent contractor over $600 during the calendar year, you must issue a 1099 miscellaneous or a 1099 NEC. Failure to do so will result in penalties. The penalties can go from only $50 per return to $580 per return. It's a good practice to get this information from all vendors. If the independent contractor fails to furnish their taxpayer ID, you must withhold 24% as backup withholding. Best practices for getting a W-9, request a form before you make the first payment to the vendor. This ensures completion of the form, which you need as a business owner for tax purposes. And be sure the correct required boxes are checked and the taxpayer has signed the form. In my personal experience, I usually tell any potential contractor that I have to have correctly filled out and signed W-9 along with a current certificate of insurance before they get paid even 1 penny. That usually gets them to get it to you right away instead of just telling them, hey, we need your certificate of insurance and a W-9. You know, from my experience, that doesn't really light a fire under any contractors. So I would ask for that, both of those things prior to paying them their first check. The next slide, this is a copy of the W-9. It's pretty simple, pretty straightforward. Just ask for their name as it's shown on your income tax return. If the name is different, you have a different business name, such as like a doing business as, you would put that on line 2. Then you would check what kind of entity you are, put in your address, and then down in part 1, you would just put your Social Security or FEIN, sign the form, and you're good to go. So there's a relief provision, Section 530. It's a provision that terminates a taxpayer's employment tax liability with respect to an individual not treated as an employee if 3 statutory requirements are met: reporting consistency, substantive consistency, and reasonable basis. So on the form 1099 miscellaneous directly, you report payments made in the course of your business. Personal payments are not reportable. If there's 10 or more dollars of royalties or at least $600 of one of the following things: rents, like I just said, 10 or more dollars for royalties, other income, federal tax withheld, fishing boat proceeds, medical and health payments. The payer made direct sales totaling $5,000 or more. This can also be reported on Form 1099 NEC. Substitute payments in lieu of dividends or interest, crop insurance proceeds, gross proceeds paid to an attorney or through a settlement agreement. Fish purchase for resale, Section 409A deferrals, golden parachute payments, non-qualified deferred compensation, barter transaction, which are exchanges of services between individuals during the course of their business, and cash payments for fish or other aquatic life you purchase from anyone engaged in the business of catching fish. Reportable payments to corporations. Medical and healthcare payments go in box 6. Gross proceeds paid to an attorney get reported in box 10. Substitute payments in lieu of dividends or tax-exempt interest get reported in box 8. All right, this is an updated version of the 1099 miscellaneous, so you can reference that with the slides and the box numbers to put the information. Other than that, it's pretty self-explanatory. So Form 1099 NEC, non-employee compensation. You report payments made in the course of your business, and personal payments are not reportable, same as 1099 miscellaneous. You have to pay at least $600 in services performed by someone who is not your employee, including parts and materials. Payments to an attorney for legal services, even if they're a corporation, and payer made direct sales totaling $5,000 or more. Nonprofit organizations are subject to these reporting requirements as well. All right, so this is a copy of the 1099 NEC where we put everything what we had just said. So non-employee compensation or a payer made direct sales totaling more than $5,000. There's also a section if you end up having to withhold backup withholding. There's boxes for that as well. Okay. Now some information on ACA, the Affordable Care Act. This applies to all large applicable employers. ALEs are U.S. employers having 50 or more full-time employees, or FTEs, which is full-time equivalents, in the previous tax year. Companies that are affiliates or are commonly controlled are treated as one employer for the purpose of determining ALE status. These companies must combine their numbers for their full-time employee total. The following persons and entities that provide minimal essential coverage during a calendar year are required to file 1095s. Those include health insurance issuers or carriers for all insured coverage, plan sponsors or self-insured group health plan coverage, executive department or agency of a governmental unit that provides coverage under a government-sponsored program, any other person that provides minimal essential coverage to an individual. Things are used to determine this, whether an employee is eligible for a tax credit if they purchase their coverage on the marketplace, whether the ALE is subject to a penalty under the employer shared responsibility provisions. Reporting requirements. Form 1095A is issued by the health insurance marketplace. 1095B is issued by the health insurance issuers and carriers. 1095C is issued by the employer to an employee of an ALE who is full-time or an employee for any month of the calendar year. Why are these forms required? All large employers over 50 full-time employees are required to offer affordable health insurance to their employees. These forms help to regulate this requirement. Employees who fail to comply, employers, pardon me, fail to comply on time or fail to properly document their compliance will face stiff financial penalties. If you need assistance, Hawkins Ash is here to help. You can go on this link to see what the services that we provide. We do provide 1095 services, including preparation of the form, filing of the form, and mailing of the forms for any clients that are in need of this service or wish to inquire about this service. Now we'll on to some Minnesota paid sick and safe leave. So this goes into effect January 1 of 2024. Who has covered all employees, part-time and temporary, working in Minnesota for at least 80 hours in a year, become eligible after their first 80 hours, and they earn 1 hour for every 30 hours worked, up to a maximum of 48 hours each year. It can be used for the employees or a family member's mental or physical illness, treatment, or preventative care. Absence due to domestic abuse, sexual assault, or stalking of the employee or family member. Closure of employee's workplace, childcare, or family member's school due to inclement weather or public emergencies. When it's determined by a health authority that the employee or a family member is at risk of infecting others with a communicable disease. The family's members which are included, you can see that list on this link. If the employer already provides PTO, vacation, or sick time above or exceeding the 48 hours required to their employees, they will be considered compliant with this statute. So ESST local ordinances in Minnesota are in effect in the cities of Bloomington, Duluth, Minnesota, Minneapolis and St. Paul, Minnesota. And these may vary from the requirements that are under the state law. So this could mean that following some of the requirements of the state ESST law and other requirements of the local ESST law as well. So goals starting in 2026, Minnesota paid family and medical leave law. Changes are still being made to this new law. This is separate from the Minnesota paid sick and safe leave, the ESST that we just discussed. You can go to this link. It will give you an update on where that law stands and if it's really going to be enacted on January 1st of 2026. Okay, a couple little miscellaneous things here as far as some year-end reporting goes. So this is just a quick little checklist before anybody should start processing their first payroll in the new year. You should enter your new 2024 state unemployment rate if it changed. Review and enter any changes for the following: health insurance premiums, health savings accounts, pension plan contributions. If there are employees who claim exempt from withholding taxes, make sure a new W-4 for federal, W-T-4 for Wisconsin, W-4MN for Minnesota is completed and filed. Verify if there are any new benefits being offered that should be added, and verify the first payroll calculates correctly by manually calculating the payroll taxes. Could save you some headaches later on as far as amending payroll reports and things like that. So as far as record keeping, you should always keep all documentation for 7 years in the event of an audit. This includes if you filed your tax return up to the extended due date, then the 7 years goes to the date you file your tax return. Recommended record retention schedule, you can find that here at this link on our site and review that further. So this last slide here, this is just where we have our offices, our contact numbers, miscellaneous things like that in both Wisconsin and Minnesota. And I'll leave that one up, and I guess everything is done. I'll turn it back over to Corrine, and if people have any questions.
Thank you, Mark. Again, if you have further questions, please reach out to either Mark or another accounting services person in our firm. We're here to help you. Please watch for an email in the next week that contains both the recording and the handouts for this presentation. It will also be available on our website. Thank you so much for your time. Have a great day.